Hi guys, it's Any, aka the Knock Trader, your friendly neighborhood swing trader, back again with another video. So there's all these investment analysts telling you to buy, telling you to sell, telling you to hold. But do they really know what they're talking about? In this video I explain to you why I don't listen to investment analysts when picking my stocks. So hit that like button, hit that subscribe button, and hit that alert button to get alerts on all my latest videos. I've got Facebook, Twitter, and Instagram at The Knock Trader on all social media platforms. And if you check the description section below, I've got a link to my mailing list. If you join my mailing list, you get priority access to my free training course for beginner traders. You get the latest videos straight to your inbox from my YouTube channel. And you get a spreadsheet that gives you my entries, my exits, my stop losses, and the reason why I enter most of my trades. So let's start with a little quote. Winning spread betting traders know that analyst recommendations are of limited value. However, losers tend to place more weight on analyst comments and in some cases use them as their trigger point for trades. This quote's from How to Win at Spread Betting. So before I get into why I don't listen to analysts, what is an investment analyst? An investment analyst is a financial professional with expertise in evaluating financial and investment information, typically for the purposes of making buy, sell, or hold recommendations for securities. So in short, what that's saying is that these investment analysts do some research and then they recommend to the market whether a stock is a buy, sell, or a hold. So most of them work for brokerage firms, investment banks, or mutual funds, and they have to have a CFA certificate. So the three main reasons why I don't listen to analysts. Number one, most of them have a long bias. So they're always about buying, never really tell people to sell. They have a fear of getting it wrong. I can relate, to be honest. Ever since I made this YouTube channel, I've been kind of scared of making silly decisions and getting ridiculed in the comments. Made a couple silly decisions, but seems like my audience are quite forgiving. And they have a conflict of interest. This is probably the most interesting one. So let me get straight into it. So what do I mean by they have a long bias? So in the year 2000, at the height of the dot-com boom, there was 28,000 recommendations by brokerage house analysts. And at the start of October 2001, over 99% of their recommendations were either strong buy, or hold. So this is what I'm talking about when I say they have a long bias. Pretty much all of their recommendations are buys. And only 0.9% of them were saying sell. This is dangerous because we all know stocks go up and down, but analysts seem to have a long bias that can result in giving buy recommendations when the stock markets are at their peak. And this could be disastrous for people following these recommendations. Imagine buying a stock based off the recommendation of an analyst when the dot-com boom was at its peak. It's a recipe for disaster. Analysts also have the fear of getting it wrong. A lot of times if you watch a guest analyst go onto CNBC or Bloomberg or something like that, they'll go for something really obscure and say prediction of what's going to happen to a stock. They'll say something like, in the long term it's positive, but in short term I think there's going to be market volatility. What does that actually mean? That means nothing. They just made a non-statement. By saying that, it makes them sound intelligent, but it also means that they're saying a whole lot of nothing, and whatever happens, they can justify what they said, because in the long term, most stocks go up. If you look at all the major indices, they go up. If you look at all of the major indices, if you zoom out to the yearly chart, they all go up eventually. So you'd have to be a genius to say that. And short-term market volatility. What market doesn't have volatility in the short term? Exactly. And the third one is all about conflict of interest. Now, before I get into conflict of interest, you have to really understand how investment banks make their money before you can really understand why there's a conflict of interest. So investment banks have three main sources of income. They've got corporate financing, brokerage services, and proprietary trading. So now let's give an example. Let's say there's Company X. So Company X has dealings with this particular investment bank. So when Company X uses the corporate financing arm of this investment bank to underwrite the IPO, so they go from, if they want to go from private to public, they will need an investment bank to underwrite their IPO. They will use this particular investment bank's corporate financing arm. And once they're publicly trading, the brokerage arm of the investment bank will be tasked with reviewing and rating the same business and providing recommendations on their stock. So straight away you can see where the conflict of interest is. This investment bank wants to continue the relationship with this Company X, but their brokerage service is tasked with reviewing and rating this company. So conflict of interest. You'll find that analysts normally have a positive bias when it comes to analysing companies that have relations with their corporate financing arm, as they don't want to create a strained relationship for the businesses. And you also find that these analysts are compensated on being, in quotes, helpful to their corporate financing arm. So I don't know what implies helpful, but I'm sure we can deduce from that if they're more favourable and a bit more loose with positive recommendations to companies that are in dealings with their corporate financing arm, then they will have more favourable compensation packets. See how that works? So my verdict is pretty simple. Analyst recommendations can be a good gauge for corporate sentiment, so you can kind of tell how a company views the stock, but I will not put too much credence in it based on all the three reasons I've stated earlier. And I'd suggest, if you do want to look at analysts' recommendations as a way of valuating a stock, and then I'd say look at smaller brokerage firms, because they tend to have less ties to big companies, so they can give a more honest opinion. And the stats don't lie. They actually have better records than the bigger investment banks when it comes to the recommendations of smaller brokerage firms in comparison to the big banks like Goldman and JP Morgan, for example. So yeah. And last but not least, I'd say a lot of the quotes that I used in this video is from How to Win at Spread Betting. It's a great book. If you're interested in finding an edge, statistically speaking, of the spread betting market, this is a good read. I have a link in the description section below. Not Trader, signing out.